Morning, Wednesday, August 26th. Not a heck of a lot of overnight data. We'll sort of jump right into it. Big number here at 8:30. 7 o'clock, MBA applications down, refis down a bit, purchases down slightly. For all intents and purposes, same numbers week over week. Yesterday, after we signed off, building permits a bit lower than expected. FHFA home prices expected zero point 0.2 came in flat last month 0.3, so down. Schiller 0.9 to 0.4 year over year FHFA, and one wonders how this is possible. Like, I get a kick out of this. So last month came in at 2.2. This month came in at 2.3. So up month over month. Last month was actually revised up. So technically down month over month, but came in at 2.4. Yet the monthly was down. So how the heck could last month's monthly be down and lower than expected, but the year over year be up? I guess there's sort of a way you can get to that number, but I always find that to be interesting. And then a total reversal, the Schiller year over year, expected 1.7, last month was 1.6, came in at 2.1. In July, new home sales, down 10.5%. Before you fall off your chair, July revised from 1.6 to up 7.6. So that's interesting. We expected 620,000 houses, call it 610, 607, I guess, to be exact. Last month revised from 628 to 678. Consumer confidence missed. So yesterday's 10 o'clock data, we didn't expect it to have a material impact on interest rates, but it's sort of a secondary sort of thing. But it kind of matters, and I would say net probably weaker than expected. Maybe that gets some attention. We're kind of flat here before the number. Bonds may be turning slightly green, maybe down a basis point. And we've got, let's just talk about while we wait, we got under a minute markets. Asia and Europe both largely better overnight. We're indicating mostly worse here. Dow slightly better, Bitcoin down. The interesting thing, even though bonds aren't rallying, Brent and crude down 2% on a day. Crude's threatening to get below 80. Looks like maybe there's a deal, maybe there's not a deal, not with us, but reopen the straight. Dollar mixed. Here we go. So GDP on the screws. It was sort of revised up. Quarterly PCE prices beat. Monthly beat, expected 0.1, came in at 0.2. Quarter over quarter core expected 3.4, came in at 3.6. Durables expected 0.5, came in at 1.1. CapEx expected at 0.9, came in at 0.2. Annual PCE 3.7 versus 3.6. The core on the screws and the monthly core on the screws at 0.2. And then headline GDP right on the screws at 1.5, down from 2.1. Market does not love it. I'm going to say that that's more of a mixed bag than it is a hurt. When you kind of look at where oil prices are, I don't think that this is terrible. We've got to kind of get inside of the number here. MBS holding up a little bit. We're definitely about 3 basis points on bond yields worse than where we were. Let me just do some house cleaning here for a sec. Bear with me. Um, yeah, going into the number, we were sort of short down in coupon a little bit, negligibly, nothing too crazy. Seth, let's cover the Fannie 6 and 6.5s if you don't mind. Um, Other than that, I kind of like where we sit positionally. Uh, we didn't want to take a ton of risk into this number, but we weren't short. I would say kind of on the screws. Yesterday was an okay lock day. I don't know if that's month end. I don't know if everybody kind of locked up before the number as was, suggested on Friday, Monday. I don't know if things are, kind of month end a little bit slower. Here's what I'm going to say to you. If you're still carrying short-term floaters, it may be time to rethink that a little bit. This PCE number by no stretch is a killer. Don't get me wrong. In fact, I might even argue, absent of this reaction, that it's bond friendly in that it kind of takes Armageddon off the table. We had somewhere along the lines of about a 67% chance of a hold in September. I mean, that's way up. We were 70% hike at one point. So what does this number do? Maybe it makes it 50-50 just sort of anecdotally. But at the end of the day, Warsh has been pretty adamant about the fact that and whatever he defines as this inflation or what we're presently see as inflation, he doesn't see monetary policy, as a shaper, a controller of that inflation. So I think that matters, right? And so I don't know that anything, what we just saw, does anything to change that. Let's see if I can get a breakdown of this PCE number. Yeah, I mean, everybody was expecting, to the point that I just made, everybody was expecting that this PCE number was going to be hotter, right? And to the extent that it wasn't really, I would think that it would be a little bit of a relief. Boy, interesting. And then, you look at MBS Live and Matt is thinking that there was optimism around this number. Boy, I wouldn't say I was pessimistic about it. I don't know that morning, Steve. I don't know that I put myself in the optimistic camp. I think a real question that I had asked was, the last print we expected to be bad because of oil prices and gas prices, and I felt like July was a slightly less favorable month, relative to maybe June in that regard, but it was sort of 50-50. We're now down about 4 or 5 ticks. I don't know. I don't see it. I don't love it. I think that this is a report that potentially ages better than how we're reading it right now. This being said, I can't seem to get my hands on sort of an up-to-the-minute, and without me kind of wasting time parsing through it, I cannot get my hands on a quick Reader's Digest of it. Let's see. Gonna look one more place. Gonna go to the actual website. So consumer spending came in a little bit better. Investment a little worse. Government a little worse. Imports a little worse. The deceleration in real GDP reflected a downturn in government spending and in decelerations in investment and export that were partly offset by an acceleration in consumer spending. Don't love that, right? When we talk about the consumer. Um, Real final sales increased 4.2 in the second quarter, revised up 0.3. The price index increased 5.8%, revised up 0.1. PC revised up 0.2. Core revised up 0.2. Obviously, both of those things we don't love. Current dollar GDP revised slightly up. I mean, just generally speaking, across the board, there were upward revisions. We're not going to love that, generally speaking. Yeah, so I think that this is one of those, it kind of depends on where you sit, right? I feel like the greater market was potentially bracing for something worse. This reaction would suggest that that's not the case. So where do you go from here? For the remainder of the day, that's sort of it. We've got the start of Jackson Hole. No one really cares about anything until Friday, 10 o'clock, but maybe. Tomorrow we've got claims, and that's really it. And then Friday we've got some data between 9:45 and 10 o'clock, but really for that, call it half hour, whatever exactly it is, we really only care about what Warsh is going to say. So long story short is you're well ahead of the game if you've been floating. You're talking before this morning's pullback, you're a full 30, 40 basis points better in almost every coupon. You continued to bet that rates were going to go down, and at least as of the moment, that bet is wrong for today. How do you play it? I think it's really a matter of your entry point. I think for us, and as I've mentioned, my bias, my long-term bias is always to lock versus float, and I kind of trade around that bias. So as I mentioned, we were incrementally short ahead of this number today, playing protect. Despite the fact that I thought the number would likely help us, there's always a paradox. And this is, I think if I get nothing across to you guys over these weeks and these days and these months, and almost a year, I mean, not quite, but coming up here in a few months, is you got to do what you've got to do, right? And even though I'm saying that I think rates are going to be lower in September, good morning, Angela, I still have to play protect. Bulls and bears make money, pigs get slaughtered, as they say. So, long story short, I think you've had a good run, and I think that this number is, depending on what language you want to use, bad enough or not good enough to kind of give you real pause. I think this is a number that's going to now be self-evident over the next 3 days, and I think that however good you felt about last month, you maybe feel kind of that much worse this month, and so now you have a neutral. That's what I'd say. I think that it would be prudent to be locked up for closings here in the next week or so. Still optimistic about the data. I think what we were hoping to build a case on is both a weakening in the employment situation and in inflation, and this is going to give us a little bit of a blip. If we can get this reopening of the strait across the finish line, and that seems to be where we stand, right? In some ways, the combination of that and whatever Warsh says on Friday renders all of this meaningless. So there you have it. Until tomorrow, Bulls and Bears make money, pigs get slaughtered. Thanks for joining and watching on replay. I will see you then.